Welcome to the Executive Compensation Podcast. I'm your host, Ryan Harvey, and on this episode, I'm joined by John Szabo and Mike Meyer. John is a partner at Meridian working out of our Dallas office, and Mike is a principal working out of our Lake Forest office. John, Mike, welcome to the podcast.
Thanks for having us.
So one of the most difficult tasks that compensation committees face every year is establishing meaningful goals for incentive plans. Most committees must set goals for both annual cash incentives and performance shares every year. These incentives often have multiple financial metrics and require the committee to not only establish a target objective, but also threshold and maximum objectives. How should a compensation committee approach goal setting to properly align company performance and motivate desired executive behaviors? Today, we'll explore a number of strategies in more detail. So John, before we get into some of those tactical approaches to goal setting, I want to start with the strategic level. So what role should compensation philosophy play in goal setting, and who should be involved in both the establishing of the philosophy and ultimately establishing of the goals themselves?
That's a great place to start with this. And obviously, compensation philosophy provides the blueprint of the guiding principles for a lot of the decisions that a board or a compensation committee makes regarding all forms of officer compensation. And so the incentive design and the specific performance goals fit within that. And so when a company or a committee is going through the decision process and evaluating a set of potential goals, certainly how it fits within the comp philosophy is important. But I think there's a separate philosophical discussion that should take place at the start as well, which is more philosophical around the goal setting process and how the committee wants to take into consideration various factors or pieces of information. So for example, a committee might say, look, we want to make sure that we're always setting our performance goals greater than prior year's actual. And so we always are looking for continuous improvement. Or they might have a philosophical perspective of, look, the performance goals might go up or go down based on the environment that the committee or that the company operates in, whether it's a cyclical industry with external macro factors, commodity prices, or whatnot that might impact it. They might also consider other factors like how the shape of the curve should look. Some committees have a philosophical preference for more symmetry or a wider shape, whereas others might say, look, we want to have more of a steep curve or a hockey stick shaped line. And so that, again, is kind of one of those philosophical discussions or items that's really important to get on the table as management is going off and developing their performance goals. I think another one is, in addition to prior year or the shape of the curve, how performance goals should compare to budget or what the company guides to the street. There are certainly committees out there that say, look, we always want to make sure that we're beating our budget or beating our guidance. Therefore, we want our performance goals for the incentive plans to be set at levels above that to motivate that we're exceeding what we're targeting. So those are the sort of philosophical discussions that I think are really important just to get on the table so that when management team comes with a proposed set of performance goals, there isn't a complete disconnect between what the committee's expecting to see versus what management's proposing. Second part of your question is also really important. Who should be in the room? A best practice with comp committees in general is to have a member of the audit committee as a member of the comp committee, ideally the audit chair, although that is a heavy load to be audit chair and on the comp committee. But at the same time, there's great insight in terms of the company's financial performance that needs to be part of the goal setting discussion. And so even if you don't have an audit chair or an audit member on your comp committee, I think it's important as part of the committee's deliberations on a set of proposed performance goals to include a member of the audit committee and get their insight in terms of how the proposed set of performance goals lines up with the discussions and the data that the audit committee is seeing. Having the controller and the CFO in the room is also beneficial, even if they don't regularly participate in committee meetings. Many times they don't. But for the goal setting discussion, having them available to answer questions that the committee has when they're deliberating a set of proposed performance goals is really important. Obviously, they're the ones that are most in the weeds and probably had a strong hand in developing the proposed goals that management's bringing forward.
Yep.
John, I'd like to add as well. I think not only who's in the room, but when these discussions are taking place is quite important as well. Worst case scenario would be we're trying to establish guiding principles and set goals in the same meeting. I think a lot of these philosophical discussions happen Q2, Q3. I've even seen many clients within Q1 have two meetings, one to propose the goals, discuss the goals, and then a second to actually approve the goals. Kind of a best process for allowing two bites at the apple.
Yeah, excellent points. I think, managing those expectations is probably one of the key objectives of the committee chair, is to make sure that when you get to the final decision, you've already, like you said, ironed out all of those philosophical issues. Because otherwise you can find yourself derailed debating over philosophical issues as opposed to really diving into the numbers when it comes time to approve them.
Yeah, and that derailment can happen on the front end or the back end. So another sort of philosophical discussion should also be around adjustments. What are the various eligible types of adjustments? Material non-recurring events, not non-cash compensation expense, things like that are pretty common, M&A expense. But even stepping back from that more philosophically, how does the committee, what's the lenses that they're going to look through when they're evaluating potential adjustments to incentive plan metrics? And, there's more discretion on the short-term side than there might be on the long-term side. But committees often will say, look, we want to make sure that any adjustments kind of cut both ways. So in years where it kind of goes against management, then we often will be sure that in years where it goes in favor of management, that we apply consistent methodology, looking at past precedent, how things have been handled in the past. The tie goes to the shareholder if there is kind of a jump ball on a metric adjustment, things like that. So
yeah. So why don't we spend a little time diving into some of the specifics, some of the specific considerations and factors that that companies should be looking at as you evaluate a goal. So Mike, obviously, internal budgets are going to play a major role in setting goals, but what are some of the other factors that committees should be reviewing and considering as they evaluate a goal?
Yeah. As you said, Ryan, obviously the internal budget is still at the core of all of this. I think historically that might have been the sole focus or the major focus. Certainly it should still play a significant role, but committees are expecting management, rather than pinpointing a number through the internal budget, to actually triangulate these goals with many different factors. So a couple of the factors that I've seen committees look at, number one would be performance, historical performance of the company. So looking back 5 or 10 years at these various metrics to see how the company has performed, to develop a trend line, but also performance relative to peers. I think this same look back analysis versus the peers helps to establish what good performance looks like. I have several clients that look at this analysis and start to set threshold goals around the 25th percentile, maximum goals around the 75th percentile. So I think it provides another kind of anchor reference point just by looking at relative historical performance. You also have to look externally. Obviously, the committee is very focused on the view of the shareholders and external parties. As John mentioned, you want to look at how you're guiding the street. Not only, with these various metrics, but the ranges within your guidance. Oftentimes, the ranges around the goals are impacted by the ranges in which you guide. Also, analyst expectations, both of the company and the industry for the coming years, is certainly an important consideration. And then lastly, there's some data analyses that you can do as a committee. Items you can look at from a long-term perspective. So, for example, a company that's using a return measure might look at their weighted average cost of capital to say no payout should be earned unless our returns exceed our weighted average cost of capital. So that becomes kind of an anchor point for the threshold. I've seen companies use a sharing ratio. This is more typical in the annual bonus plan. This would be for an earnings type metric. They would analyze for each incremental dollar of profitability, what percentage is going to the shareholders and what percentage is going back to the participants in the plan. And again, I think all of these reference points don't necessarily have a magic answer. There's no share ratio number that says this is a good plan versus a bad plan, but it gives the committee a gut check, which I think is helpful to have these various reference points. And the last one I'll mention from a kind of data standpoint is market data. Now, obviously, each company and their circumstances are very different from one another. But if you look at this over multiple years, similar to the performance, you can start to analyze performance goal ranges. So from a peer perspective, you're looking at threshold and maximum as a percentage of the target goal. And you can also analyze how companies are establishing their goals relative to the prior year actual performance. So John made a comment earlier that some committees philosophically believe target goals should always be set ahead of prior year actual. Well, we can look into that with the peer companies over an extended period of time, 3-5 years back, to see if that holds true amongst peers.
Yeah, those are all excellent points, and I think every company and committee needs to figure out what of those various factors, what are the ones that they want to focus on, and then really look at those on an annual basis to make sure that they've covered all of the areas that allow them to have good business judgment when they're determining goals.
I think that's right, Ryan. I don't think these necessarily are all used by all companies each year, but some are more important to the particular company than others. And I think, like I said, as long as there's a bit of a triangulation as opposed to one reference point, I think that's what our committees are looking for.
Yeah. So I want to dive into performance curves themselves. And so we've talked a little bit about this, but just to kind of set the stage for everybody that's listening. So, when we look at bonus plans and goals, they typically have a target. They typically have an upside maximum and a downside threshold. And when you plot those on a grid with both the goals themselves, so if it's an earnings goal, what's the target goal, the max and the threshold, and then the payout opportunities relative to that, if you plot that out on a grid, it becomes a curve. And so you'll hear us talk about the performance curve. So John, I want to get into that curve and the nuances of how do you set those points and the slope of the curve, and really focus on maybe two things. One, how does the metric itself, and there's all kinds of financial metrics we could choose from, how does that impact those different points in the curve? And then also just, if we look at the outcomes and the predictability around those outcomes, does that impact the curve itself? If we're in a very unpredictable economic environment, does that have any impact on how we shape that curve?
Yeah, it's a great question. And setting target is challenging. Setting the threshold and maximum goals is even much more challenging. And that's where a lot of committees tend to spend a lot of their time. Where do you set those spreads? And often you do see a different spread between threshold, target, and max goals for top of the income statement revenue type metrics, where theoretically it's a little bit more predictable for company revenues in a year, and they tend to be a little bit wider as you move your way down the income statement. So if you have an operating income goal, EBITDA, it might be a little bit wider than the revenue range for revenue-based goals. And if you use a net income or an EPS, then it would potentially be even a little bit wider spread between threshold, target, and max than it would be for an operating or EBITDA type metric. There's also a variety of ways committees might evaluate, other than the data that Mike was just talking about, that might lend itself to different spreads. Some committees philosophically want uniformity across the metrics that they have in their incentive plans. And they might just say, look, we're going to set target at whatever the target is, and the threshold and max is going to be 85% of target, and max is going to be 115% of target. And a lot of companies go about it that way for right or wrong. I personally think that companies should take a little bit more tailored approach when they're considering their threshold and maximum performance goals. There's the budgeting process or the planning process. Often there's multiple scenarios that are run when a company is going through their budgeting or planning. And again, if the budget or the plan tends to be a strong influence on the target performance goal, then you might have your and that probably is the most likely case of your scenarios, your budgeting scenarios, your worst case or best case scenarios help inform that threshold and maximum performance goal. I think also the period of cycle or uncertainty might help inform the spread as well for companies that are in a little bit more volatile industry, a little bit harder to forecast. They might have a wider spread range between threshold and target and max. Versus those that it may be a little bit more predictable and it'd be a little bit more narrow, regardless of the type of metric. And the metrics themselves, aside from income statement-based metrics, cash flow metrics, if it's a absolute dollar goal versus a percentage goal, might lend itself to a different spread between the threshold, target, and maximum. There's also the law of small numbers and big numbers, and how that plays into how you set those threshold and maximum goals. So all to say, there is certainly a lot more art than there is science, I think, when it comes to setting the upper and lower limits of performance goals that spread threshold to max to target. Also, I think it depends a bit on the rigor or the aggressiveness of the budgeting process. And some companies just set very stretched budgets. And if that's the case, then you might see a wider range between threshold and target goals, knowing that that target is quite a stretch, and then maybe a little bit more narrow between target and maximum. Because again, with a stretched target, the theory there would be make it a little bit easier to get to max if we're already, asking a lot of management to push for a target. So that all, is part of the calculus that a committee should take into consideration. Probability is another one. Companies might consider what's our 10 to 20% chance of hitting a number, and that's maybe your maximum goal. What's an 80 to 90% or a very, very highly certain chance of hitting a number, and maybe that's your threshold goal. So a number of inputs, again, as Mike was talking about, and kind of philosophically ways to think about threshold, target, and max spreads.
Yep. Makes sense. What are any thoughts you might have on breakpoints? So, occasionally you'll see a curve that doesn't just have a threshold, target, and max, but it has other breakpoints either above threshold, between threshold and target, or between target and max, where the curve slope changes at a point. Any thoughts on that, of when that may or may not be appropriate?
We've definitely seen examples of that, kind of a flat spot, maybe a range around target, where if you hit within 97 to 103% of your target, that pays target regardless of where you are in that range. And then the line continues on above or below that 97 or 103% marker up to the maximum and down to the threshold number. We see that during periods of uncertainty. We saw that in, like you said, I'm located in Dallas, work with a lot of oil and gas companies. When the commodity cycle was in its down cycle a few years ago, a number of my clients took that approach, given the uncertainty around setting a target goal for an income statement or a cash flow based metric. You might see that we saw that during COVID, for example, where, again, very challenging environment to set a performance goal with a great degree of confidence. So apply a range. So I think it's certainly more of an exception than the rule. And it's something that if a company has that in place, they should continually test whether or not it's appropriate to continue that sort of range around target or flat spot each year. But it is a practical way to help get around some uncertainty that might take place, given, the type of operating environment that a company finds itself in when they're trying to establish performance goals.
Yep. So John, you just kind of went into some thoughts on uncertainty, but I want to probe that a little bit further, Mike, with you, specifically around that. So, so often we work with companies, they're in various levels of economic uncertainty, business uncertainty, and that's when it really becomes difficult to set goals, particularly if we're talking long-term incentives. And I want to get into that in a minute here more, but what are some of the strategies that the company should be considering when they're in particularly difficult, uncertain times?
Yeah, Ryan, and as John alluded to, we have clients and industries that are very cyclical in nature, where this is old news to them, right? They're very comfortable with these different types of strategies. But even over the past couple of years with the COVID pandemic, some of the inventory shortages, this was held true across many of our clients. Clients that were very used to the philosophy of setting a target ahead of prior year actual, maybe had to make the tough decision to take a year where you step back, where the performance target is set below prior year actual. That would be one strategy. A handful of other ones we talked about recently, the kind of flat spot in the curve. Sometimes it's not even a flatter slope, but actually a plateau. Some companies will set a range for their target goal, so not to reward or penalize management for somewhat of an immaterial miss of the target. You would still get 100% in a small range around the target. Some of the beyond just the target, if you look at the threshold and the maximum, you can, as we alluded to before, you can start to widen these ranges in times of uncertainty, depending on how wide you go and whether or not, the widening is more permanent or temporary. You might also want to correlate that with the payout ranges as well. I've seen clients that had a 50% threshold payout, but after lowering the performance goal, they decided to reduce the threshold payout to 33%. So having a correlation between the performance and the payout is important as well. Beyond the ranges, there's certain techniques you can use to actually establish the targets that are quite helpful in some of these uncertain economic times. One we've seen very successful in long-term incentive plans is it may be difficult to set a target dollar amount over the long term, but the committee may be able to agree upon a standard growth rate that they find acceptable. If we're talking top line revenue, that might be 5% per year over the next several years. And so that 5% actually becomes your target, a compound annual growth rate over that 3-year performance period. And then you set various growth percentages as the threshold and maximum as well. We've seen that used effectively, but again, that's a philosophical type decision. The other technique we see quite often, especially in the long-term plan, is pairing these absolute goals with a relative metric. So the most common you would see in the marketplace would be a relative total shareholder return. So instead of having to say we expect 10% stock price growth over the next 3 years, what you would say is we expect the company to outperform the median or the 75th percentile of some peer group or some index that the committee finds acceptable in terms of shareholder return. The last approach I've seen, and this is typically quite industry specific. For example, if I pick on the retail industry, with pretty severe uncertainty during the COVID pandemic, you saw the shortening of the performance period itself. So from an annual bonus perspective, rather than setting 1-year goals, which became challenging during this time, you would see 6-month goals or quarterly goals even. From the technology industry, we often see in the long-term performance plans, rather than a 3-year cumulative goal, which might be quite challenging in such a quickly evolving industry, we might see a 3-year performance period, but annual goals within that 3-year performance period, quite common amongst technology companies. And the one thing I'll say about all of these techniques, certainly each one comes with a varying degree of external scrutiny. So I think it's always important that no matter what decision you make, it's very intentional and that you have a good story to tell externally when you're reporting the use of these various techniques.
Yeah, a lot of great strategies, and we could dive into each one of those and spend a lot of time getting into the weeds, but a lot of good things to consider. So final question I want to throw out, we've been talking about all these different techniques and strategies around goal setting. They generally apply to all kinds of different types of incentives, but there are some differences between how you might approach a short-term incentive that's only a year in length versus a long-term multi-year stock-based incentive. So John, maybe lay out some of the considerations that might be a little bit different depending on which type of incentive we're talking about.
Yeah, you're exactly right. And the key point there is the line of sight. If you're setting a 1-year performance goal, I would imagine companies have a greater degree of confidence in that 1-year outlook than they might on a 3-year longer range plan. Virtually every company sets their annual budget. I think when you look across companies, there's varying degrees of sophistication when it comes to the long range planning process. And some companies are still figuring it out. Some companies have a very, very rigorous, robust process around their long-range planning. Ultimately, as we've talked about, there's a lot of data points that come into the consideration, and all of that should be taken into consideration, whether you're setting a long-term goal or a short-term goal. Inevitably, the annual bonus plan tends to be very influenced by the budget or the annual operating plan, as we've talked about. The longer range, long-term plan should align with the company's long-term, long-range strategic plan and what they're communicating to investors and what they're striving for over the next 3-5 years, as opposed to a 1-year increment. you tend to see different metrics between the short-term plan and the long-term plan. Bonus plans tend to be more income statement cash flow based. Long-term plans tend to be more market based, total shareholder return, and balance sheet, like a return on invested capital. Not to say that you don't find income statement or cash flow metrics in LTI plans as well, but generally speaking, that tends to be the prevalence between the two. The long-term incentive plan, if you're measuring total shareholder return, for example, often is measured on a relative basis. And so you don't really have to set performance goals. Instead, you're just setting the cut-ins at what percentile against a peer group or an index do we want to pay out at threshold, target, and maximum. And there it's a little bit of signaling and to the market or rigor around, do we want to be greater than median, or are we paying target at median? And obviously we know the proxy advisors and shareholders weigh in on those spreads quite a bit. The return on invested capital balance sheet metrics, often, as I think Mike mentioned earlier, it's rooted to start off in your weighted average cost of capital. And potentially it's a little bit easier if you're using a return on capital metric in the long-term plan, because often it's measured over an average, right? An average ROIC over 3 years, as opposed to kind of, picking a number that's 3 years out. So there's a lot of parts of the process that should be consistent, whether you're setting a short-term plan or a long-term plan, but just the nature of the metric itself, I think lends itself to a little bit of a different process in the LTI plan. For TSR, like I mentioned, for the cut-ins, that's one consideration. We see more and more use of absolute TSR now, for example, or even stock price hurdles. And those are even, much more challenging to set. If you're setting a stock price goal, if I knew how to do that well, I'd be sitting on a beach not talking to you right now, that's for sure. But we see there's different ways to break apart, for example, an absolute TSR goal, where you might consider, well, how much can we expect to generate in returns through our dividend or a buyback? And then what is more of an organic price appreciation? Do we need to at least, beat the S&P 500 8% benchmark? And when you put those two pieces together between the dividend and a more organic price return, what does that tell us about our absolute TSR goals, or what do our analysts or shareholders expect our price or TSR targets to be over the coming cycles? So in sum, it is different based on the types of metrics you use, but a lot of similarities in the process in terms of philosophical considerations and data points that you consider.
Yeah. Now this has been very helpful. I mean, I think we've covered a lot of very helpful considerations as committees struggle through. This is one of the more difficult things that they have to deal with every year. So a lot of helpful considerations. And John, Mike, thanks again for coming in and joining the podcast today.
Great talking to you.
Appreciate it. Thanks, Ryan.